The Intelligent Investor, by Benjamin Graham, is a classic finance book that was originally published in 1949. It presents timeless principles and strategies for investing, with a focus on value investing. Here are some key ideas from the book. Number 1. Value investing. The book introduces the concept of value investing, which involves analyzing stocks to find those that are undervalued by the market. Graham argues that investors should look for stocks that are trading at a discount to their intrinsic value, and that have a margin of safety. This approach focuses on the long-term fundamentals of a company, rather than short-term market fluctuations. Number 2. Margin of safety. Graham emphasizes the importance of a margin of safety, which is the difference between the price of a stock and its intrinsic value. He argues that investors should only invest in stocks that have a significant margin of safety, to protect themselves from the risks of the market. Number 3. Mr. Market. Graham uses the metaphor of Mr. Market to explain the behavior of the stock market. He argues that investors should view Mr. Market as a moody and irrational partner, who offers to buy or sell stocks at different prices every day. Rather than being swayed by Mr. Market's emotions, investors should focus on the underlying value of a company. Number 4. Diversification. Graham stresses the importance of diversification, which involves spreading investments across different stocks and asset classes. This helps to reduce the risks of individual stocks or sectors, and to provide a more stable return over the long term. Number 5. Margin trading. The book also warns against margin trading, which involves borrowing money to buy stocks. Graham argues that margin trading is risky and can lead to significant losses, and that investors should avoid it. Number 6. Investor versus speculator. Graham differentiates between investors and speculators, arguing that investors seek to make a profit through the ownership of a company, while speculators seek to make a quick profit through market fluctuations. He emphasizes the importance of being an investor, not a speculator, and focusing on the long-term value of a company. Number 7. The importance of analysis. Graham stresses the importance of analysis in investing, and provides a framework for evaluating stocks. He suggests looking at a company's financial statements, its management, and its competitive position in the market. Number 8. Contrarian investing. Graham advocates for contrarian investing, which involves buying stocks that are out of favor with the market. He argues that this approach can provide opportunities to buy stocks at a discount, and to earn a higher return over the long term. Number 9. Investing in bonds. In addition to stocks, Graham also discusses the importance of investing in bonds as a way to diversify a portfolio and reduce risk. He provides a framework for evaluating bonds and suggests focusing on high-quality bonds with a low risk of default. Number 10. The role of psychology. Finally, Graham acknowledges the role of psychology in investing, and suggests that investors need to be aware of their own biases and emotions. He cautions against making decisions based on fear or greed, and suggests staying disciplined and focused on the long-term fundamentals of a company. Number 11. Buy and hold strategy. Graham advocates for a buy and hold strategy, which involves buying stocks with the intention of holding on to them for the long term. He argues that this approach allows investors to capture the growth potential of a company, and to avoid the risks of market timing. Number 12. The Dividend Principle. Graham also emphasizes the importance of dividends in investing, and suggests that investors should focus on companies that pay regular dividends. He argues that this provides a steady stream of income and a measure of stability in the stock market. Number 13. The margin of safety in bonds. In addition to stocks, Graham also applies the concept of the margin of safety to bonds. He suggests focusing on high-quality bonds with a low risk of default, and buying them at a discount to their intrinsic value. Number 14. The importance of patience. Finally, Graham stresses the importance of patience in investing. He suggests that investors need to be willing to wait for the right opportunities to come along, and to avoid making impulsive decisions based on market fluctuations. Number 15. Market fluctuations. Graham acknowledges the inevitable fluctuations of the stock market and advises investors to remain calm during these times. He suggests that investors should focus on the intrinsic value of a company, rather than the current market price. Number 16. Contrary opinion. Graham discusses the importance of having a contrary opinion when investing. He suggests that investors should be willing to challenge the consensus view of the market, and to look for opportunities in stocks that are out of favor. Number 17. Psychology of investing. Graham acknowledges the role of psychology in investing and suggests that investors need to be aware of their own biases and emotions. He cautions against making decisions based on fear or greed, and suggests staying disciplined and focused on the long-term fundamentals of a company. Number 18. Investing in mutual funds. The book also discusses the benefits and risks of investing in mutual funds. Graham suggests that investors should look for low-cost funds that provide exposure to a diversified portfolio of stocks. Number 19. Defensive investing. Graham introduces the concept of defensive investing, which involves focusing on stocks that are less susceptible to market fluctuations. He suggests that investors should look for stocks in industries that are less cyclical and have a history of stable earnings. Number 20. Intrinsic value. Finally, the concept of intrinsic value is a key idea in The Intelligent Investor. Graham suggests that investors should focus on the underlying value of a company, rather than short-term market fluctuations. He provides a framework for calculating intrinsic value and suggests that investors should only invest in stocks that are trading at a discount to their intrinsic value. Number 21. Margin trading. Graham warns against the dangers of margin trading, which involves borrowing money to invest in the stock market. He suggests that investors should avoid this practice, as it can increase the risk of significant losses. Number 22. Investing in real estate. The book also discusses the benefits and risks of investing in real estate. Graham suggests that investors should carefully evaluate the potential return on investment, as well as the costs and risks associated with owning property. Number 23. The role of management. Graham emphasizes the importance of management in investing and suggests that investors should carefully evaluate the leadership of a company before investing. He suggests looking at a company's track record of earnings, its management philosophy, and the quality of its leadership team. Number 24. Market timing. Graham cautions against trying to time the market, arguing that this is a risky strategy that can result in significant losses. He suggests that investors should focus on the intrinsic value of a company, rather than trying to predict short-term market fluctuations. Number 25. Risk management. Finally, The Intelligent Investor provides practical advice on risk management, including the importance of diversification and the use of stop-loss orders. Graham suggests that investors should focus on building a portfolio of high-quality stocks and bonds that provide a measure of stability in the market. Number 26. The concept of Mr. Market. Graham introduces the concept of Mr. Market, which represents the stock market as a whole. He suggests that investors should think of Mr. Market as a sometimes irrational partner in their investments, who offers to buy or sell stocks at different prices based on his mood. Number 27. Dollar cost averaging. The book discusses the benefits of dollar cost averaging, which involves investing a fixed amount of money into a stock or fund at regular intervals. Graham suggests that this approach can help investors avoid the risk of buying stocks at the wrong time, and can provide a measure of discipline and consistency in investing. Number 28. Investor versus speculator. Graham distinguishes between investors and speculators, suggesting that investors focus on the long-term value of a company, while speculators focus on short-term market fluctuations. He argues that investors should avoid speculation and instead focus on building a diversified portfolio of high-quality stocks and bonds. Number 29. The importance of education. The book emphasizes the importance of education in investing, and suggests that investors should be willing to continually learn and adapt to changing market conditions. Graham suggests that investors should stay informed about the companies they invest in, as well as broader economic trends and market conditions. Number 30. Active versus passive investing. Finally, the book discusses the debate between active and passive investing, and suggests that there are benefits and risks associated with both approaches. Graham suggests that investors should carefully evaluate their own skills and interests, as well as market conditions, in deciding whether to take an active or passive approach to investing. Overall, The Intelligent Investor is a comprehensive guide to value investing that provides practical advice on building a diversified portfolio, managing risk, and avoiding common pitfalls in the market. The book remains relevant today and is a must-read for anyone interested in investing. Please hit the subscribe button for the support of our channel and share our videos for more new upcoming content. We are very happy to create new ideas and review for everyone. God bless and happy listening.